So guys, thank you so much. We are really looking forward to having this conversation about the future of retail. But let's start with a poll just to set the stage. So take out your phones. You know the drill. Let's put it up here. These are all your instructions. I'm not going to go through them. So let's put up the poll. What's your view on malls? Here are the questions. What's a mall?
David and I get a vote?
Yes, we're going to ask you to vote. What's a mall? Malls are mostly dead. That's a Princess Bride reference for those of you in the audience. Malls will live for another 25 years. Malls forever. All right. So some Princess Bride fans
we know
here.
where Jeff and I are.
Everybody know. Oh, no.
Malls are
a couple what's a malls. Those are millennials.
Malls, oh. Neck and neck.
Pretty optimistic view. All right, we'll let it
Come on. I think Jeff and I get it over. We get it over the hump.
You get it over the hump. All right. So, are malls dead?
David and I are here to say that malls are not dead. Any
Surprise. Well,
That's shocking.
Well, tell us why malls aren't dead. I mean, we've certainly seen, I could throw out the numbers in terms of store closings. Like, we keep seeing, like, record amounts of stores that are closing, malls that are under pressure. Tell us what works and why this thesis of malls being dead, it doesn't make sense.
Well, I was going to let you're a big client, so I was going to let you go first. But
wait, this is one of those. No, you go. No, you go.
I'm happy to say, look, the mall itself has been around for 60 years, and there are a lot of changes in retail that have tried to put the mall, quote, out of business, and it is so much more resilient than kind of the typical person would view it. So there, you had the street retail, you had power centers, you had the online phenomenon, you had Walmart. And the fact is, if you have good real estate in well-located catchment areas, and you're always changing and evolving the product, the sustainability of that real estate and that cash flow has been proven over a long, long period of time. So if you go back 60 years and look at a mall versus what it is today, it's always evolved, and it is much more resilient. And then again, that doesn't mean that there isn't a mall that goes out of business, but I look at it like Yahoo. If you thought search was not effective, then because you could have concluded Yahoo went out of business because search wasn't effective. But the reality is Google dominates search. So if in retail, you're going to have a few malls that go out of business, primarily because the trade area has changed. And if you think about it, something was built 60 years ago, the population goes left, right, north, south, east, west. And but if you're well located, the mall will always continue to evolve, and who occupies it is always changing. And I'll let Jeff chime in here, but we have live examples. I know, Jason, you're from Atlanta.
And let's talk about that. Let's talk about Atlanta. It's my hometown, and we were just down there not too long ago. And right in Buckhead, you've got Lenox Square, you've got Phipps Plaza. Those are both Simon properties. You've got some stores there. It feels like that's a little bit of a microcosm. Tell us what's going on there.
Just to add to what David is saying, I think that when you look at malls, healthy malls take partnership and they take joint investment. And I think that Lenox is a great example of that. When I think about Macy's journey in our mall portfolio, it's really looking at where the mall developers are developing in those malls, where they're investing in those malls, and having a point of view about what they're doing, how they change in their retail mix, what are new experiences they're bringing into these malls, and where does it make sense for Macy's to put their dollars to make our subset of that mall more vital. And Lenox is a great example of it. That was one of our early growth stores. I knew what David was doing, what he was doing on the Phipps side, and what he was doing to reshape that because they're right across the street from each other, what he was doing on the Lenox side, what he doing in terms of the mix of retailers that were changing. And then where that gave me the confidence to be able to invest in my four walls. And that has been a great investment for us. I mean, that was an earlier adopter in our growth strategy. It's now given us 2 consecutive years of growth. And we have lots of properties, like that. I would say we're working together more closely than ever. And so when you think about our teams, they're on the phone every week, they're meeting every month. We're learning, we share 80 properties together. So, and David has got a higher concentration of his properties in A malls, and those are always going to stand the test of time. But they're going to be different, 10 years from now than where they are today, and that takes shared investment.
And I was just going to add on, and so at Phipps, where we have Saks and Nordstrom, and then across the street we have Bloomingdale's, Macy's, and Neiman Marcus. We had another department store because of how well Macy's does with both Bloomie's and Macy's itself. There was no need for it. So it was a lease. We took it back. And just to give you the math real quick, we took the store back. That department store was paying us $1.5 million. Yeah, Jeff's going to be shocked at this. He pays no rent. But this particular department store paid $1.5 million. We demolished it. It's actually under construction and putting a Nobu hotel, office building, Nobu restaurant, Lifetime Fitness, food hall, entertainment. And that same piece of real estate is going to generate $35 million of what we call NOI or cash flow. And the best thing ultimately, it's very sad and tragic, but the best thing that's going to continue to rejuvenate and reposition the malls is as we get Sears real estate back.
Right.
The ability, and Jeff's very aware of this, and many of our properties together, the ability to diversify the mix, bring in entertainment, bring in health and wellness, bring in restaurants. Historically, we've been hamstrung because we haven't had the real estate. Now we get the real estate, and then that's really the next leg of the mall business. And again, just because a mall goes out of business doesn't mean the mall product isn't very sustainable with future cash growth characteristics.
But where do you look? Where do you think you are focusing your efforts on in terms of opening up new malls or new Macy's? What are the types of places that you're looking for?
So what we're looking at is we're looking at how to use our existing portfolio and make it stronger. And so there's many properties that we have. We've invested in 150 stores. We're getting growth in aggregate. And
these are the renovations that you guys have been doing.
These are all the renovations that we're doing. And, and I'm not doing that without knowing what David and his contemporaries are doing with remixing the mall. So there may be opportunities. What you're seeing in a lot of this is that they're mixing it away from apparel and accessories, which fortifies the strength of the department store. And he's putting more food and beverage and more entertainment. When you look at the leasing of what's happening in these malls, cavities that are, as David described with the Phipps, is happening across the country in a number of properties. So those are great properties for me to invest in, and then we're looking for opportunities off mall. But for the ones that we're in right now, we have a long runway of opportunities ahead of us where I've got malls that, like David and his contemporaries, where they're investing and where I can as well.
And so talk to us about what those investments look like on a granular level. Like when you are remaking a store in the vision of a modern mall, knowing, because you are in such good contact, what he's doing, how are you changing the footprint? How are you changing the experience? Like, give us some examples of that.
So in the past, what we would do when we would remodel a store is we would go all in, and it was not a scalable model. There was not the return on investment that we needed. We were spending $10 million for each of these properties.
You would just gut it.
We would just, we'd gut it or you'd gut most of it, right? And now what you're seeing is we're spending about $3 million on these properties, and that's just one of the strategies that we have, is that we're redoing lighting, all the amenities that you would expect, and we're adding new businesses. So we're adding Backstage, we're adding Big Ticket. Those are two businesses that are doing really well in our portfolio that not every one of our growth stores have. We're adding new brands in. So that's one element. It's product and its environment. The other piece is really focusing on the people, what we're doing with our management, what we're doing with colleagues, what we're doing with commission rates, then what we're doing with marketing, what we're doing with special events. So a lot of these malls, the opportunity to get the community in and for us to go into the community is high. So what we can do to get more footsteps into these stores is very high. So it's the combination of those 5 things that really is what is driving the overall business. And, a good example of this is David had a mall, one of our first meetings together was when he was kicking my butt on King of Prussia. And King of Prussia it's one of the best malls in the nation. And we had a tired product, The Macy's brand was shop-worn. And he was saying, hey, look, this is everything I'm doing. This is everything that I'm investing. And you're behind. And this is the dollars per square feet increases that I'm getting. These are all the leasing, agreements that I am changing. And get busy. And
I said it much more politely.
so polite about it. And it was, he was absolutely right. And so that was one of our first stores that we invested in. You know, in our first year we did that was 2018. We got a 2% increase. This year we're getting a 4% increase on that. It's the gift that keeps giving because investment is not a one and done. Yeah. I think what we've learned in this business is that you have to continue to invest in new content, new experiences, because the customers raise the bar on all of us.
Yeah, and this is beyond just real estate. I mean, I don't care if you're in a technology company, you have to invest in your product. And going back to your question, Carol, it's funny, you know, New York is the hippest city in the country. Let's assume that, okay?
We like to think the world.
Okay, the world.
We'll
Yeah,
go
I'm
with
okay
the
with
world.
that.
But go on.
That's debatable in the world, but it's a hip city. Yet in the last 5 years, 3 malls have opened. Okay.
Yeah.
Now we're not involved in any of them, but you have Hudson Yards, you have the World Trade Center, and then you have Brookfield Place. So it's interesting that the hippest city in the world. Yet open 3 malls. And it's kind of, the narrative, and I'm not blaming Bloomberg at all, maybe slightly, but the narrative.
Wait a minute, now it just took a funny turn.
Right. The narrative is so negative, yet when you look at the facts, I think you can draw a much different conclusion.
What do you make of something like the American Dream? I just have to bring it up. And I mean, it's a saga, 20 years, but across the river.
Once known as Xanadu. That's my favorite part.
Once known as Xanadu. It wasn't an Olivia Newton-John song only.
Tom Barrett called it Xanadon't after a while. But go on.
So, but I mean, I feel like that's on steroids in terms of the hockey ring and all these experiences that are in their high-end stores.
Yeah.
Is that kind of where we're moving? That people go to do things and then they shop? I mean, how do you see it?
Answer that.
Well, I don't want to be. I'll be politically correct. We bought the company that ran into financial trouble, back in 2007, called the Mills Corp. One of the requirements before we bought the company, we had a terrific turnaround with the company itself, and made a ton of money for our shareholders. One of the quids that we had for, popular word these days, but one of the quids we had in buying that is we did not want that property as part of the portfolio. And I think that's when they sold it to Colony. And I think my actions speak louder than any words I'm going to say.
We'll leave it there.
Okay.
So, Jeff, take us inside a store. I'll start with you, Jeff, and then move to you, David. This notion of where the consumer is right now.
Yeah.
Every day on our show, I feel like we're hearing these conflicting reports of consumers great, consumers enthusiastic, consumers spending money. We're going into a great holiday season. Businesses, however, are a little hesitant. CapEx is down. What do you see across your customer in terms of their mood and their optimism or caution right now?
I think the customer, it's not as good as it was a year ago, but it's still a very good climate for the consumer to consume. And so I think retail is relatively healthy. And what I'd say about the customer journey is it's not monolithic.
Yeah.
You don't design a store with one journey in mind. I think any retailer out there is getting increasingly the journey of the customers is really pushing us on the balanced investment. So we're all investing in omnichannel, we're all investing in mobile, we're all investing in brick and mortar, because that journey is getting tighter and tighter. Mm-hmm. And so it's really important when they come into a store, that journey may say, hey, I want to come in. I just bought something when I was on the couch last night. It's being delivered to that building. I want to get in and out within 2 minutes. That same customer may be back to you the next week and they're planning a wedding, or they're with their daughter and she's going to prom and she wants a stylist to help her with the dress, with the makeup, with the accessories. So you've got our consumer guides us on all this, and you got to make sure that the journey that we're on between all of our balanced investment is in line. And so what we look at in our stores is what's the most convenient way for her to get in, get out? Where are the experiences that we are going to invest in? Which are the ones that are not value add? We make those decisions at a local level. I think every retailer has their gig, but that's what we're thinking about.
You said her. Is it mostly her?
It's mostly her. About 70% of the decisions are either for her or being made by her.
Yeah.
But I got to tell you, our business is particularly good with the male customer. And, maybe we should play with our pronouns here.
Okay.
Right.
I was just curious.
For him or her, what did you think would work that didn't? whether it was experiential or an upgrade that you made or a service that maybe just didn't pan out the way you thought it would?
I think there's a number of them. I mean, we're learning all the time. So we're testing things, and then based on what we learn from those tests, that we're then iterating it, and then we scale from there. So, I could point to many concepts that started out a particular way that we ended up killing, and others that started out and have morphed into something different. Very rarely do we get it right from the moment we do it. And I think the mark of any great retailer is one that is experimenting much faster than ever before. You're not doing it in a test tube and then you're like launching something fully formed. The faster you can get in front of the customer, they'll tell you every time. And you can do that online with concepts. You can do it in a store with experiences.
What is the role of online in all of this? We know, but how do you complement then your brick and mortar? What's the best strategies?
Yeah, what I'd say on omnichannel is that we have more content, or we have more traffic that's coming through mobile than any other channel right now. But she's browsing, she's checking prices, she's going to the influencer, she's transacting. So when you look at mobile, we had $1 billion in sales last year. We're up 50% on that between the Bloomingdale's and the Macy's platform. She's using it to navigate in a store. She's checking out in a store. So at digital it enables brick and mortar to be much healthier, and brick and mortar seeds digital activity. Right. They're so intricately linked.
Right.
And any retailer that doesn't have brick and mortar will. And any pure play is either doing partnerships with brick and mortar or they're developing their own stores, and vice versa.
Yeah, and if you look at La Tote and Lord & Taylor is a good example. If you look at what we just did with Michael Rubin and Root Gilt Group, RGG, and what we're doing with our own, we're also very big in the outlet business, like we own Woodbury Commons. And I hope when you went to Stanford, by the way, you went to the Stanford Shopping Center, which is a Simon Mall, which again, I got to get a plug in, right? Okay. Which again, we have two of Jeff's.
We used to have three now.
Okay, right.
We took two Macy stores and made it one.
True. But the ability to communicate with your consumer, ultimately through all of your internet capabilities and your mobile, and then drive them to the store or drive them to the shopping center is really critically important. And then we think ultimately with RGG is to make it a seamless transition from where it's mostly focused on value. If you know Gilt or Rue La La, it's flash sales, value oriented. We're bringing our outlet business online through our Shop Premium outlet marketplace. We put it all together to focus on that, and it's gonna drive traffic both to the site and ultimately to the physical properties. Right. And it's when you ask Jeff about service, and this is again counterintuitive to the narrative and counterintuitive. So you know what our number one complaint is about the mall environment from our consumers? You're about to say it. Parking. Okay.
Really?
Yes, really. So we're always trying to improve this. How do you? And we all have the 80-20 rule that our best customers basically do the most shopping. And so how do we create an environment where parking is really easy and really convenient? Because that's another way to make the experience so much better.
David, one of the things I wanted to make sure we asked you about, and it actually calls back to Jim Coulter, who was on stage earlier, because they're an investor, as you know, in Lifetime Fitness.
So are we.
And you are as well now.
Yep. I hope he was nice to us.
It's been a good investment for them so far, them and Leonard Green.
Yeah.
But that does call to mind, I think, for me at least, this notion of, and you got into this a little bit earlier, sort of what are the more profitable elements at this point? As you look at the mix of what's in various shopping centers, where are you making the most money?
Well, I mean, it's across the board because if you look at an average size mall, there are 100 stores. So, we don't make any money off Jeff and his stores because we have historical, maybe a little bit. Okay? There's a historical relationship. No, but it's a good partnership.
Well, chilly on the other couch.
But like Lifetime's a great example. I mean, besides our corporate investment, we took a Sears back that was in a mall in North Shore, north of Boston, where again Jeff has representation there, and we had an old dilapidated Sears. It was brand negative to the mall. We had spent a lot of money on the mall, and that gave us there was no return coming from Sears because they owned the real estate. We bought it. We're leasing that space to Lifetime. Then around it, we're able to add entertainment and restaurants in the front of the shopping center. At the end of the day, we'll get a return on equity or return on investment that's higher than the value of that property would otherwise be sold on kind of a cap rate basis. And that's how we can justify our investments. Now, that's not to say every investment is offense like that. I mean, there are certainly defensive investments like any other company has to be confronted with. But that's where. So we're not dependent on one single retailer or one single concept or one single restaurant or one single entertainment. It's a combination of all, and that's why even with all the ups and downs in retail and in the economy, our cash flows have been resilient.
Right.
And that's that the market needs to ultimately recognize that once again.
And it is interesting to think about the idea that even in the sort of consumer's mind, the halo effect of having a Lifetime Fitness versus a Sears, like you feel differently when you see that on so many levels because one feels like success and one doesn't.
Time to move on.
Yeah.
Time to move on.
Well, what about like these stores, and forgive me for bringing up a competitor, but I think about what Nordstrom's doing, and they have these smaller stores like in the city, and it's really not about selling goods, it's about a place to return stuff from Macy's or others, and it's also a place to maybe get something tailored. I mean, it's like this whole other concept.
Or a whiskey.
Or a whiskey, if you're lucky. But I do wonder about, maybe that's a way of creating loyalty to a brand. And so what do you guys think about that as a strategy?
I think it's going to be interesting for them. I mean, I think that obviously when they're coming into a market like New York City, and it's a very established market, not every customer, and you think about where it is on what side of the city it's on, if they have a portal that gives a customer convenience where they can interact with the brand in another part of the city, it's something that has to be considered. So in the same conversation that we're looking at off-mall opportunities for, we've got a lot of customers that would consider the Macy's or the Bloomingdale's brand that want to shop in brick and mortar, but the mall that is either not convenient for them or they don't want to go to it. So it amplifies our business on digital whenever you have a storefront. It can operate as a marketing tool. It can be a portal by which they can have something delivered or return something.
So you might do something similar?
Possibly.
Possibly.
Possibly in the future.
Yeah.
All right, we've only got about 90 seconds left. David, I want to start with you. Biggest single challenge as you look at the year ahead for your company and for you?
Look, I think it's just the continuation of reclaiming real estate that we can do much better with. So, and Sears is a great example. We don't own all the real estate, and what we're focused on is how to get that on economic terms where we can invest and make money, and that's ultimately going to pay a lot of benefits for the consumer and the communities. One of the things that's really important for the communities to know is that we are the largest taxpayer in the communities, and we generate enormous sales taxes for our communities. So if you take Roosevelt Field, between our sales tax and our real estate tax that we generate from that facility, you're talking roughly $130 to $40 million for that community. And I think, a warehouse that sells online goods, let's argue that it's the same stuff more or less, doesn't do that. They don't do that. And I think it's important for us to get the story out how important we are to the community in terms of viability of that community, teachers, firemen, et cetera. And that's a story that we hope to tell better.
That's a great point. Jeff, your biggest challenge as you look at 2020?
Balancing growth. So both top and bottom line growth. So we've been very public about our pursuit of that. What I know is that America loves to shop. And when you think about the Macy's and the Bloomingdale's brand, they come to us for fashion. So that's our wheelhouse, and how we can continue to show top line growth, but also bottom line growth is what we're hotly pursuing.
So is the mall dead?
No,
Mall's not
man.
dead.
Come shopping with us and we'll show you what.
Jeff Gennette, David Simon,
Thank you.
thank you
Thank
so
you guys.
much.
Thank